September 2008, a 158-year-old investment bank files for bankruptcy. Within days, global markets convulse, retirement accounts shrink, credit freezes, millions of Americans lose their jobs. The collapse of Lehman Brothers becomes the symbol of the worst financial crisis since the Great Depression. But the roots of that moment go back years, built on cheap money, rising home prices, and a widespread belief that housing in America could only move in one direction: up, the easy money era. In the early 2000s, the United States was recovering from the dot-com crash and the shock of 9/11. To stabilize the economy, the Federal Reserve aggressively cut interest rates. Borrowing became historically cheap. Low rates had an immediate effect. Housing boomed. Mortgages were easier to obtain. Monthly payments looked manageable, and home ownership was promoted as both a financial decision and a cultural milestone. Buying a house wasn't just practical. It was patriotic. It was stability. It was the American dream. But lending standards began to erode. Traditional safeguards, income verification, solid credit histories, meaningful down payments were relaxed. Subprime mortgages expanded rapidly. These loans were designed for borrowers with weaker credit or inconsistent income, often carrying adjustable rates that started low and reset higher later. For many borrowers, the risk was manageable only if home prices kept rising, and at the time, they were rising fast. Housing as speculation. By 2004 and 2005, housing had shifted from long-term investment to short-term speculation. Buyers purchased multiple properties with little or no money down, expecting to flip them for quick profits. Rising prices reinforced confidence. Each sale at a higher value validated the last. Banks and mortgage brokers were incentivized to originate more loans. The faster they issued mortgages, the more fees they generated. Whether the borrower could sustain payments long-term became less central, but local banks were not holding these mortgages on their books. Instead, they were selling them to Wall Street. Financial engineering. Large financial institutions pooled thousands of mortgages together and transformed them into investment products known as mortgage-backed securities. These bundles were then sliced into different layers of risk and return. More complex structures, collateralized debt obligations, or CDOs, followed. Through financial engineering, loans made to high-risk borrowers were repackaged and sold globally as diversified investment-grade assets. Crucially, many of these securities received high ratings from agencies such as Moody's and Standard & Poor's. High ratings made them attractive to pension funds, insurance companies, and institutional investors that were restricted to holding relatively safe assets. The system appeared stable. Risk had been distributed widely. Demand for mortgage-backed products remained strong, but the underlying loans were growing weaker. Betting on collapse. A small number of investors examined the structure of these securities and concluded that the risks were misunderstood. Adjustable rate mortgages were scheduled to reset at higher payments. Many borrowers would struggle when that happened. To capitalize on that view, Wall Street created credit default swaps, financial contracts that functioned like insurance against bond defaults. Investors could effectively bet that certain mortgage-backed securities would fail. Institutions such as AIG sold enormous volumes of this insurance, collecting premiums under the assumption that widespread defaults were unlikely. The system had become highly interconnected. Mortgages supported securities. Securities were insured by swaps. Those swaps were often backed by thin capital reserves. Leverage amplified everything. It worked until home prices stopped rising. The turn. In 2006 and 2007, home prices began to stall and then decline. Adjustable rate mortgages reset at higher payments. Delinquencies increased. Foreclosures followed. As defaults rose, the value of mortgage-backed securities fell sharply. Financial institutions that had treated them as safe, liquid assets suddenly faced massive losses. Confidence evaporated. By 2008, major firms were under severe stress. In March, Bear Stearns required emergency support. Over the summer, government-sponsored mortgage giants faltered. Then, in September, Lehman Brothers filed for bankruptcy after failing to secure a bailout or buyer. The bankruptcy triggered a systemic panic. If a firm of that size could fail, counterparties everywhere were exposed. Banks stopped lending to one another. Short-term funding markets froze. Credit, essential to everyday economic activity, became scarce. The crisis quickly spread beyond Wall Street. Businesses struggled to secure financing for payroll. Consumers faced tightening credit. Stock markets plunged globally. Economies from Europe to Asia felt the shock. The United States had entered what would become known as the Great Recession. Government intervention. Faced with cascading failures, the U.S. government intervened on an unprecedented scale. In October 2008, Congress approved the Troubled Asset Relief Program, or TARP, allocating up to $700 billion to stabilize the financial system. Major banks received capital injections. AIG, whose exposure to credit default swaps threatened broader contagion, required over $180 billion in assistance. Automakers also received support. At the same time, the Federal Reserve cut interest rates to near zero and launched large-scale asset purchases, commonly known as quantitative easing, to restore liquidity and confidence. These measures stabilized financial markets over time. By 2009, panic had subsided and equity markets began to recover, but the damage to households was severe. The aftermath. Unemployment peaked at 10%. Roughly 8 million jobs were lost. Millions of homes went into foreclosure. Household wealth fell by trillions of dollars as property values and investment portfolios declined. For many Americans, the crisis reshaped trust in financial institutions and policymakers. Large banks survived, in part due to government support. Few senior executives faced criminal charges. Public frustration culminated in protests such as the Occupy movement, centered in New York's Secaucus Park. The crisis exposed structural vulnerabilities: excessive leverage, weak underwriting standards, conflicts in credit ratings, and insufficient oversight of complex derivatives. Reforms followed. Capital requirements were strengthened. Certain derivatives were brought under greater regulation. Consumer protections expanded. Yet the core lesson remains relevant. Financial crises rarely announce themselves clearly. They often grow quietly. Inside incentives, assumptions, and widespread optimism. In the early 2000s, the prevailing belief was simple: housing prices do not fall nationwide. In 2008, that assumption proved wrong. And when it did, the consequences reached far beyond a single bank.